thank you all for joining us in this virtual breakout session. It's I think one of the interesting challenges in this virtual world is sort of imagining what this is supposed to mean in a non-virtual world. And so I can see us. I know there was a main stage session, and this is a breakout session. Very much appreciated you all joining us. I'm joined here by my colleague Steve Kaplan, head of our Portfolio Insights group. I'm David Kelly, head of the Market Insights strategy team in JP Morgan Asset Management. And what we'd like to do is I'm going to take about 15 minutes to lay out how we see things 2 weeks ahead of the election in terms of the pandemic, the economy, the election, of course, and also what that means for broad investment strategy. And then I'm going to turn it over to Steve to talk about how we analyze portfolios in Portfolio Insights, both in general, and then actually also perhaps talk a little bit about scenario analysis, which is one other aspect of what we do here in Portfolio Insights to try to help people build the best portfolios for any environment, and of course think about the current environment. So when I think about where are we right now, it starts with the pandemic. I think any outlook has to start that way. Where we are is, unfortunately, we're entering a third wave. I think we're all sort of familiar with these charts now of what the number of cases has done. First of all in the spring, and then it died down, and then over the summer, and it died down, and now as we go into the fall, the number of cases is going up again around the country. And I think, unfortunately, it's probably going to be a higher peak this time around than any of the prior peaks because the weather is turning colder, because people have got pandemic fatigue, because there's a certain amount of political division on the issue of should you be wearing masks or not. That, unfortunately, is allowing the coronavirus to spread. And I do think that's going to push up the total number of cases over the next few months. The mortality rate, the number of people dying from it will probably stay roughly constant at a grim and terrible total of about 1,000 people a day. And that really reflects the fact that even though the number of cases is going up, the way we treat the disease is getting somewhat better. But still, I think a grim fatality rate going into 2021. We do expect that there will be vaccines, multiple vaccines approved, which will be safe and somewhat effective, or pretty effective. And it does sound like we are able to conquer this thing. It just means a more united approach. And it's going to take some time for us to get there. We're going to have to all get together basically as a country and observe basic public health practices. And then we can use a vaccine to leverage down the overall numbers. Because what a vaccine really does is it slows the spread of the disease a lot. And so you can, instead of having rising curves, you can have falling curves. And then hopefully, as we go to the summer and the fall of next year, most people will actually get the vaccine, and then we will be able to finally get past this pandemic. Looking at what it's done to the economy, we've got growth in jobs and profits and inflation. It's not a V-shaped recession or a U-shaped recession. What we've really had is a plunge in GDP, a bounce, a crawl, and then a surge. So we've had a plunge in the first and second quarters. Then we've got a big bounce in the third quarter. We think GDP will be up by about 35% annualized in the third quarter. But that will still leave the economy about 3% smaller than it was in the fourth quarter of 2019. And to put that in perspective, in the great financial crisis from peak to trough, the drop was 4%. So it's still a very significant recession that we will have to recover from beyond the third quarter. And unfortunately, growth will slow. The lack of a stimulus plan or another stimulus package is hurting. I think the lack of, and the spread of the pandemic is also hurting. And so I think you get about 3% growth in the fourth quarter, first quarter of next year, and then things begin to pick up and accelerate as that vaccine gets distributed and we can all get back to normal. On jobs, we gained 24 million jobs in the great long expansion of 2009 to 2020. We lost 22 million of those jobs. So basically, they were all wiped out in 2 months between February and April. We've now regained about 11 million of those jobs. We've still got over 10 million jobs to go. So about halfway back in terms of employment. And I think that employment growth is slowing down, will slow down over the next few months. But I do expect at some stage in 2022, we will hit a new all-time high in employment. On profits, it has been a significant decline in profits, particularly in the first quarter. and to some extent in the second quarter, profits have not been hurt as badly as the overall economy because the industries that are most important for the S&P 500, things like tech and financials and consumer staples, they're actually able to operate pretty much okay. And of course, healthcare in this pandemic environment. We don't think profits will quite hit an all-time high in 2021. I think the economy will be subdued enough that you don't hit an all-time high in 2021. But by 2022, you could see an all-time high on corporate profits. Of course, then you may have a tax increase, so you might have to wait until 2023 to get to an after-tax all-time high on corporate profits. But I think we're on a road to recovery. And on inflation, we have not seen as big a decline in inflation as you'd expect given the degree of the recession. I think particularly in the second half of next year, when you've got both stimulus feeding through the economy and you've got the vaccine and people getting back to their social activities and trying to buy plane tickets and hotel stays and sporting events and trying to find a restaurant, all these things will actually push up inflation, I think. And so I do think the overall consumption deflator inflation rate will go above 2% year over year in April and stay above that through the rest of next year. And then it could get higher still in 2023, which is kind of interesting. And it's interesting because if you look at all this, look what the Fed has said. What the Fed has said, they've adopted this new average inflation targeting program, which I'm sure you're all familiar with or have heard of. But the idea is that because inflation ran below 2% for a number of years, they want to run inflation above 2% for a number of years. Now, what they've said is in order to achieve that, they will not raise the federal funds rate until two things happen. First, you need to have inflation hit 2% on the way above 2%. And second, you need to get to maximum employment. Now, Jay Powell says that that isn't exactly the same thing as their long-term target for unemployment, which is 4.1%. You also need to see some wage growth. You need to see higher labor force participation. But if we keep this sort of a simple model that it means you've got to get the unemployment rate down to about 4%, that's not going to happen in 2021. It's not going to happen in 2022. It might happen in 2023, depending on how strongly the economy is growing. But always getting those last 1 million or 2 million people employed, it's always a struggle because they're frankly the hardest people to employ in the economy. And that really sets up an interesting situation. You could get to inflation above 2% without hitting that employment goal. So what does the Fed do? They've said they won't raise short-term rates. But if they don't raise short-term rates, they may cut back on bond purchases at the very time that the federal government, through a stimulus package, is adding further to the deficit and the debt. And that could mean higher long-term interest rates. So I think you'll see yield curve steepening over the course of 2021 and going into 2022.
David, one of the questions that came through might be worth addressing now is what the outlook for the 10-year is at the end of next year, if you have a ballpark.
Yeah, I think at least 1% higher than this. So I would think we're in the 1.75 to 2% range by the end of next year, based on that steepening of the yield curve. And I know that may seem like a lot. I don't know if it does seem like a lot right now, but I think that just reflects the fact that the Federal Reserve, we could run a $3 trillion deficit next year. We ran a $3.1 trillion deficit in the fiscal year that ended on September 30th. It could be as much as $3 trillion. I think we will get a fiscal package after the election. I think we'll get another one with the new Congress. And if the federal government is trying to borrow $3 trillion and the Federal Reserve is buying $1 trillion of bonds and maybe tapering that, I do think you get higher long-term rates. And then on the election itself, it's not too close to call, but it is too early to call. I think I would only feel half confident of making a call on the election just before, on the eve of the election itself, based on opinion polls. I will say that it is more likely that we'll get single party government than we get divided government. If there are enough votes to re-elect Donald Trump, I expect that Republicans will hold the Senate and take the House. If there are enough votes to elect Joe Biden, then the Democrats have got a pretty good chance of holding on to the House and at this stage taking the Senate. I think that is possible. I will say that single party government of either stripe, I think, will lead to more fiscal expansion next year. Obviously different objectives in terms of immigration, in terms of energy, green energy versus fossil fuel, more immigration versus less immigration. But either way, for an investor, I think one of the most important things to recognize is that we've got a point of almost maximum uncertainty right now. We don't know about the pandemic. We don't know about the election. We don't know about the economy. 6 months from now, very likely there'll be less uncertainty. We'll know where we are in terms of the government. We will probably have a vaccine, and we'll kind of know something about the distribution pace of that vaccine. And in that kind of environment, you could, if uncertainty goes down, that should help equities overall, but it could also, move away from momentum trades in terms of large cap, mega cap growth stocks and government bonds, which people have been pouring money into, to maybe thinking a little bit more about valuation. And if this market if people look at the market in terms of valuation, then value does look cheaper than growth. And also, I think you've got a situation where international equities look cheaper than domestic issues or domestic equities. And then finally, I'd say that if inflation does begin to move up, things like real assets, real estate also need to be part of a portfolio. So I'll stop there, and obviously we'll keep an eye on the questions here. But at this point, I'd like to turn it over to Steve to talk a little bit about portfolio insights. Steve?
Thank you very much. Thank you, David. Thank you, everybody, for your time. I'll give a quick background on Portfolio Insights for those that are not familiar. It's a program we started 7 years ago, which is really around analytics to help with portfolio construction and investment selection. We started with a by request service, meaning advisors would send in requests for analysis on their portfolio. And we've grown that over time, where we've done thousands and thousands of analysis for advisors looking to bring scale to their practice. We also heard from advisors that they appreciated the program, that they wanted something that they can do on a self-serve basis. And so a couple of years ago, we came out with digital portfolio insights, where you can go onto our website, you can run this for prospects or your end clients. It does provide a FINRA approved output. And in there as well, we provide observations, and there are guide to market slides that are linked to those observations so that you can share those with your clients. We do things like normal holdings-based look-through, but we also get into stress tests. So how did your portfolio perform in a COVID environment? We do scenario analysis, with Dr. Kelly alluded to, where he talked a little about the different potential outcomes of the election and what they may mean for a portfolio as an example. And we also look at contribution to risk as well as return in the portfolio. So just for anybody that is interested in that, in the expo room, you do have access to a tool if you would like to go in and just play around with it a little bit. I did want to share 3 observations that we are seeing, and they are the most frequent observations that we've seen in the portfolio across the 2 aspects of the program, meaning the digital tool as well as what our team runs. We've done 90,000 analyses in total year to date and done thousands of calls. And what we've seen from that are a couple of different things. One, that that question that came through on what outperforms U.S. value versus the S&P or the NASDAQ has created a bias in a portfolio where there is a significant overweight to growth and growth investments, full stop, in the portfolio. Part of that has to do with international investments as well, where the international investments that are being selected are a bit growthier. But in general, what we find is that the allocation to international is less diversified, and it's less allocated to than it should be. And that's not a tactical call. That's more structural in terms of a strategic outlook. We feel that if an average advisor has around 27% of their equity exposure in international, that should be somewhere in the ballpark of 35 and 36%. And then lastly, the struggle or the search for income, depending upon how you think about it, is very real. Everybody is obviously looking for yield in this challenged environment. We've seen a rotation back where high yield was an overweight in the portfolio. It's moved back to investment grade, but the caveat is that the overweight is still to the lower grade of investment grade, more in that triple B type of approach. And our thinking is really that fixed income, of course, you want to have diversification within there, but you want to make sure that your fixed income is serving as a ballast and that there are other areas of the market that you could look at. David talked a little about alternative investments as an example, as ways to provide income, but still make sure that you are appropriately diversified in your portfolio. So those are 3 of the main highlights. I do want to, again, make sure we have some time for some of the questions. So David, maybe I would point to just, you touched on value and international. Any thoughts on those relative to U.S. specifically? And then any thoughts on small caps relative to history? Those are a number of the questions that have come through, if you want to touch on those.
Well, thanks, Steve. So on international versus domestic, I perhaps should have used the marketing opportunity to mention our guide to the markets, which we update on our website every day by 10 a.m. And just looking at page 56 of the guide right now, if you look at the relative price to book ratio of emerging market stocks versus the S&P 500, it's almost as cheap as it's been at any time since 2001. So emerging market stocks are cheap relative to US stocks, and cheap by about 1 standard deviation. And similarly, if you look at the MSCI EFA index of international stocks, they are more than 1 standard deviation cheap relative to their 20-year average. So both international equities and both developed country and emerging markets are cheap. But there's another thing that I think is really important, because people are always looking for income in this environment. And if you look at page 75 of the guide, we point out that the dividend yield on EFA stocks is about 2.6%, on EM stocks 2.3%. 10-year Treasury bond, the coupon is only 70 basis points or 80 basis points. So there's a dividend, there's an income opportunity in international stocks also. And then we also, in the equity section of the guide, we do look at growth versus value on page 10 of the guide. And again, if you look at it on a valuation basis, value is 1.3 standard deviations cheap relative to growth. Now, cheap, yeah, but what's going to change this? I think what could change this is simply getting past uncertainty, because again, people ask me about 1, 3, 5 years. Well, just 1 year from now, as we talked about earlier, I think we're going to be looking at higher long-term interest rates. I think we're going to be looking at less uncertainty. And if you've got a less uncertainty, higher long-term interest rates, that should help value stocks, should help with a cyclical rebound. If you've got less uncertainty, maybe people use the dollar less as safe haven. I think the U.S. trade deficit will be higher, so I think the dollar will be coming down. So you put all this together, I think that within 1 year you could easily see outperformance of emerging markets, international equities in general, and also value versus growth in the U.S.
The other question was about the weighting for small caps. And obviously that will depend on the size of your portfolio, or rather the risk profile of your portfolio. And you can find this, again, all within the tool. So we have model portfolios with underlying strategies, as well as index-based concepts. So roughly for a 60-40 portfolio in total, we're calling for about 8 to 9% in small caps for a 60-40. But again, you can see all the different numbers on the site as you look at the different benchmarks. David, maybe just a question for you on a Treasury bubble and any thoughts on utilizing gold in a portfolio?
Well, yeah, I think there is a risk of a Treasury bubble here, because I write something on LinkedIn every week, and I wrote something called The Problem with MMT a few weeks ago, just talking about modern monetary theory, which is the idea you can run, it's deficits without consequences. But of course there are consequences, and I think that the truth is there are no hawks left in Washington. There are no monetary hawks, there are no fiscal hawks, there are no Democratic hawks, and there are no Republican hawks. They're all doves. And in this environment, when you get past the election, I think you do get a lot of fiscal stimulus. You do have a lot of treasuries issued, but the problem is that could cause inflation, particularly if we approach full employment and the dollar begins to fall a bit and people get a little worried about inflation. You end up with inflation. If you have inflation, then rates rise. And so you could get into a nasty situation, which of course we had in the 1970s, of inflation beginning to bubble up and the Federal Reserve needing to raise rates to slow it down. In that kind of environment, yes, you could see some dollar devaluation. I do think that, relative to the euro, relative to Japan, I think they could be seeing the same problem. So, I don't really see this as a big dollar decline issue. But would it make sense to hold real assets? I think so. I think there's some sense in holding gold in that kind of environment, or at least having some allocation to gold. I'm no fan of Bitcoin, which I think is just nonsense, and I think it will be shown to be nonsense in the long run. Sorry, but I think gold is a reasonable, limited supply, traditional real asset, and also real estate. I mean, I think you can see that in the housing numbers right now. A lot of people have figured out that in an inflationary environment, and we do remember back in the inflation of the 1970s, real estate is something to think about. So yeah, I think there's some risk there. I think it's a risk that you need to hedge against.
Great. Just looking quickly. Any thoughts? So we've both talked about alternatives. Any thoughts around balancing out the high yield positions with what type of alternatives, what concepts you would look at? I mean, I could certainly share as well after you do.
Yeah, but I think that's a question that speaks to portfolio analytics. So I think I'll put that one back in you, Steve.
Yeah, I mean, so I would say it really is obviously going to depend on why you're buying high yield, right? I mean, you can, and we're talking more on the private side. I'm assuming, obviously, there's a whole bunch of more 40 Act liquid alternative type strategies that you could, in theory, look at as a replacement for high yield. But if you're looking, obviously, just to maximize returns, then that might be one thing. If you're looking for income, we would probably think about something along the lines of maybe real estate or infrastructure, where you're getting some pretty decent yields. Private credit as well, right? And it's all about having the right balance of those in your portfolio. Yeah. Maybe one more, and I know we're going through a good amount quickly, but question on the allocation or just thoughts in general about wide moat mega cap stocks going forward, like Microsoft or Apple after the election?
Yeah, I'd be careful about them, because I think the problem is with a lot of these mega cap stocks, you just have to sit down with the spreadsheet and ask yourself, yes, these have been great, successful companies in many areas, and they may in many cases have benefited from the pandemic, but we're not going to be in a pandemic forever. And they're not going to be the only player in town forever. And so can you, on a spreadsheet, find a pattern of cash flows going forward which will be sustained that can actually justify the price of the stock? Because I think, right now we're in a very momentum kind of market, but in the long run, as uncertainty diminishes, I think valuation will become more important, and that's something to think about. I did also see somebody in the chat room talk about, foreclosures are coming due to the pandemic, and so prices are going to go lower. Look, there will be some foreclosures, but I wouldn't overstate that one, because right now, yes, there's a hesitation to do fiscal stimulus because they're playing politics with it. And that's what's going to go on for the next 2 weeks. When the election is over, nobody in Congress wants to be the Grinch that stole Christmas and had somebody thrown out on the side of the street before Christmas. And as I said, there are no hawks left. So I expect to see significant fiscal stimulus to try to tide landlords over, to try and tide tenants over, to prevent foreclosures. We've got very low long-term interest rates. We do have some home building going on right now, but we don't have an excessive stock of houses on the market. I think one thing so I don't think there'll be a huge wave of foreclosures in the long run, because I think we'll have the government step in to try and tide us over until the pandemic ends. I think we will get a CARES Act 4 or 5 and a CARES Act, CARES 2 and CARES 3, basically. And then the other thing that I do think depends on the election a little bit is immigration. If you get a blue wave, I think you get more immigration, and that will put a lot of demand into the housing market. We get back to 1 million immigrants per year, and that's basically vanished. If, however, we have a red wave and we tighten the screws in immigration and you don't have any immigrant growth, then I think a wave of foreclosures is a little bit more likely, because you just won't have that demand for real estate. So I think that is something that depends on the election a bit. But right now, I don't think mortgage rates are below 3%. People have not taken out crazy mortgages like they did in the housing bubble. I don't think we see a wave of foreclosures.
Great. Well, I think we'll cut it there, just in the interest of time. But thank you, everybody, for all of your questions and for joining us. I would just point out to the question that was asked about this site we were talking about, where the tool is available. If you look along the left-hand rail on the bottom, there is Expo, and that's where you can find a link to our website that will take you to the tools. Or if you go directly to the JP Morgan Fund's website under Tools and Resources, you can find it there as well.
And could I also add that, please, if you do have a JP Morgan representative, you have a question we didn't address, please just send it to that JP Morgan representative. They'll send it on to us in Market Insights, and we will answer it as quickly as possible. And again, thank you so much for coming to our session.
Have a great day, everyone.
Thanks.